Hey guys, Peter Hafner, Certified Financial Planner and Certified Financial Fiduciary. And today I wanted to come to you and talk about, follow up on a video I did a little while ago. So some of you might have seen it. It was about our friend Bill wanted to take some money out of an IRA to go see a concert. If you haven't seen the video, the link's below. Check it out. And in that video, I told you that Bill got hit by something called the Social Security Tax Torpedo. And he wound up paying an effective tax of over 40% on a $1,000 IRA distribution. And he's only in the 22% tax bracket. So it doesn't really seem possible, but it did happen and it can happen to you. So I want to follow up on that today and show you what happened and why it happened so that maybe you can avoid it. And if you can't avoid it, at least you'll understand what's going on. So let's start with this. Let me give you some basic information about Bill's tax situation and his income situation. Bill's got retirement income before the concert, or I should say IRA income. He took $40,000 out of his IRA. And to go on the concert, he took an extra $1,000 out. Bill's Social Security income, of course, was the same before and after he took the money out of the IRA. It was $37,500. Now, how much do you think his adjusted gross income is going to go up if he takes an extra $1,000 out of his IRA? Probably $1,000, right? I mean, that's what's intuitive. That's what you would expect. But the problem is, that's not what happens, okay? Bill's adjusted gross income increases from $65,538 to $67,388, okay? It's more than $1,000. And then there's a cascading effects here because his taxable income increases from $48,988 to $50,838, resulting in income tax going from $58,030 to $62,037. So that's an increase of $407 because of a $1,000 IRA distribution. And that just doesn't make sense, right? Or it doesn't seem to make sense. But what happened is Bill got hit by the Social Security Tax Torpedo. And what happened is for every additional dollar of income Bill received, an additional $1.85 was added to his AGI, his adjusted gross income, and his taxable income. Doesn't seem fair, but that's what happened. And the reason this is happening is because it has to do with the way Social Security is taxed. Social Security is taxed based on your other income, not your Social Security income, your other income. And if your income's low enough, you don't pay any tax on your Social Security. And that's where Bill had been before. But after he took that extra $1,000 out, his other income was higher. And if your other income is high enough, up to 85% of your Social Security can be taxed at your personal rate. So for every dollar that came out of Bill's IRA, $1.85 was taxable at his 22% bracket. And that came out to a 40.7% real tax rate on that extra $1,000 of income. And if you want to see sort of a chart of the way this looks, this is why it's called the Social Security Tax Torpedo, because once your income goes to a certain level, a certain portion of it is taxed at 49.95% before it drops back down to 22% for the additional income after that. So that's the way this works. And the reason I'm bringing this to your attention is it could be you're in a position where you can avoid this, number one. I mean, Bill had other options, right? Or he might have had other options. Maybe Bill didn't have to take that money out of his IRA. I run into lots of people who take money out of IRAs and 401ks, and they really don't have to. They got money in the bank, but for whatever reason, they do that. So Bill, if he would have took the money out of his bank account, he wouldn't have paid any tax, right? Because that's already after-tax money. Or maybe Bill had a Roth IRA. He could have taken the money out of the Roth IRA, and it probably would have came out totally tax-free. But he didn't. He took it out of his IRA, which resulted in this onerous tax on that distribution. So the most important thing I want you to take away from this video, a lot of you, if your income's high enough, you can't avoid this. This is sort of baked in. There's nothing you can do about it. But the thing I want you to understand is this is an example of how the tax code is not intuitive. So a lot of us think we understand the tax code, but I am telling you, there are so many tripwires and trapdoors you can fall into. And this is a relatively small example, right? I mean, it cost Bill $400 some. Not that big a deal, I guess, right? But what if it cost you $4,000? Or what if it cost you, your mistake cost you $40,000? These are the kind of things that really happen to people. These are the traps you can fall into. So it's really, really important. This is the main message today. You need to have a well thought out plan as you're approaching retirement and entering retirement. And it's got to include taxes in retirement, because having a well thought out plan is going to help you avoid making costly mistakes. It'll help you pay less in taxes and keep more of your own money for yourself and your family. So you're able to do the things you want to do instead of giving more money to the IRS. That's it for today. Hope you found this useful. Please click the like and subscribe button. Click the bell so you know when we put up new videos. Feel free to share this with your friends and relatives, and have a great day.